Okay, good morning, everyone, and welcome to our first event this week of the Coffee Microcaps Appendix 4C results wrap. I'm excited. We've got four interesting presentations this morning, and it's the first of 12 that we're going to have over the course of the next 3 days. My name is Mark Tobin. I'm the founder of Coffee Microcaps, for anybody who's joining us for the first time. I'd also like to thank our virtual event sponsor, Merweather Capital. If anybody's looking for a new microcap fund and fund manager, please reach out to Luke. I believe he's just dotting I's and crossing T's at the PDS, with hopefully going to launch his new fund sometime in November. So I'll just quickly run through these introductory slides, and then we're going to run straight into it with our first presenter. For anybody joining us for the first time, this event and indeed the Coffee Microcaps morning meeting events, you'll normally find that the companies are under 300 million in market cap, in revenue, and approaching cash flow break even, or indeed are already profitable. They're generally from outside the biotech and resources sectors, what I like to call industrial microcaps. So that's microcap technology names, microcap healthcare, microcap retail, consumer goods businesses. Structure this morning's webinar, and we normally have 2 companies presenting, but we've actually got 4 this morning. Each company has a 30-minute slot, which we're roughly going to break down to a 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box. Just makes it easier for me to manage when we get to the Q&A rather than the chat function. Please note the webinar is being recorded, and it should be up on the Coffee Microcaps YouTube channel tomorrow morning, say about 11:30. If you can't stay for the full 2 hours, you can watch it back then if you wish to do so. You can follow Coffee Microcaps. Twitter is the best place to get us. YouTube for this recording, and indeed all the recordings of our events to date. It's approaching, I think, 60 or 70 events at this point. LinkedIn, and I also write a weekly paid subscription newsletter where I profile one interesting ASX microcap stock every week, and you can get that on the Coffee Microcaps Substack platform. First up, we're going to have Oleg Vornik, CEO of DroneShield. After that, we're going to have Maria Halasz, CEO of Cellmid. Then we're going to have Brendan Kavenagh, CEO of AD1 Holdings Ltd. And then to round out this morning's events, we've got Simba Matute, CFO of Angel Seafood Holdings. So without further ado, I am going to stop sharing my screen, and I know Oleg is standing by. Oleg, if you want to start sharing your screen.
Great. Thank you, Mark.
Yeah, I can see the cover slide now. Yeah, I can see your cover slide now. Oleg, you're good to go.
Thank you, Mark, and good morning, everybody. I'm Oleg Vornik, the Chief Executive Officer of DroneShield. DroneShield is an Australian-based counter-drone electronic warfare and tracking systems business, and the update I'm presenting today reflects our September quarterly results that we released to ASX yesterday. Firstly, about our business. What is DroneShield and what are we trying to do? Drones, and when I say drones, I mean small consumer drones like what you can buy in JB Hi-Fi, have started a trend of a new type of technological threat alongside of all the positive applications of drones. Organizations like ISIS and other terrorists have adapted small drones to drop harmful or explosive payloads. We also started seeing intelligence gathering on the battlefields and also by common criminals using drones and their powerful cameras, as well as people flying drones around airports, creating nuisance. It's a new type of asymmetric threat that new technology has enabled. The next slide gives some of the headlines that we've been seeing in the news about the use of drones. So on the right, you can see the holes in the Saudi Aramco's oil facilities that disrupted the oil market about a year ago when it happened, as well as vast array of other situations where people were using drones to disrupt the operations across vast array of markets. In terms of the possible applications, military is our largest segment to date. So this is detection and defeat of essentially terrorists like Houthis or others using small drones to conduct that sort of near airspace attacks. Then we'll work with quite a number of intelligence services around the world to provide them with that counter-drone awareness and threat. We work with a number of police agencies, including Australian Federal Police, here to enable them protection against drones being used for either terrorist attacks or general nuisance. The airports, we all heard about Gatwick Airport being disrupted by drones a couple of years ago, as the threat is if you have a drone being caught onto the engine of the aircraft, unlike bird strikes, there's a strong risk of the engine being blown out and potentially downing the aircraft and significant loss of life. In the stadium context, this is prime area for terrorist attacks, but also people potentially taking footage of the games and disrupting the broadcast rights of the TV producers. And the list just goes on. For example, prisons, the criminals delivering contraband like cell phones, escape kits, drugs across the fences, and many, many others. So how do we achieve this aim? The first step is detection. Drones are actually remarkably difficult to detect with the naked eye unless you have specialized equipment. Drones today, even cheap ones you buy in an electronics shop, can fly often up to 10 kilometers in range. They're fairly quiet and they just blend in with the background. You imagine white drone against white cloud. Traditional equipment is not designed to detect such drones. For example, traditional radars can detect shiny reflective metal objects like large aircraft, but certainly not small plastic objects flying close to the ground. So you need dedicated equipment, hardware and software, which has not existed prior to the start of this threat. The next step is assessment. So you want to be able to track the drone, understand what kind of drone it is. The general rule of thumb is bigger the drone, bigger the problem, as of course, bigger drone can do bigger payload. You might potentially have a swarm of drones attacking the facility. So all of that is important in terms of both real-time assessment and also reporting statistics. So we've been contacted by facilities, for example, where in Australia, prison believe that they have about a couple drone flights a week delivering contraband. After deploying our equipment for a month, they realized they have more like 20 flights a week. But say during nighttime with the lights out on the drone, it was simply impossible to detect when the drone was coming in. The last step is response. So what you're seeing on the first picture of that futuristic gun image, that's actually not a rifle in traditional sense of shooting a projectile. So what that product does is that it emits a radioactive signal, or shall I say radio frequency signal, apologies, that effectively disables a drone. So it's a safe disablement where the drone gets cut off from the pilot, from the satellite, and it safely lands itself and it works against swarms as well. And then we make jammers in different form factors. So you see a jammer on a vehicle on the bottom right picture as well. And often for some facilities, we even advise them to not even do the defeat. So if you're a prison, we can tell you where the drone lands, who picks up the package, and also where the pilot of the drone is. So then you can send security and apprehend the pilot and the person who picks up the package and conduct investigation and resolve the issue. Slide 6 shows the complete suite of our counter-drone products. So in a summary, it's a combination of hardware and software. Starting from top left, you have our dismounted and body-worn drone detection family of products. And then going down, you have the vehicle fixed site, and also training and simulation, location sensing, and also a sonar for underwater drone detection. All of the detection products come with a layer of subscription-based software. This is quite important. So as new drones come out, you need new software to detect those drones. We use artificial intelligence engine that we release new firmware version of every quarter. So when somebody buys, for example, an RF Patrol body-worn detection device, with it comes an ongoing subscription stream. So over time, we expect that SaaS subscription element to continue growing, and fundamentally will become a SaaS business with software living on the fleet of the hardware devices that we've now been selling for last several years. On top of the counter drone, we also have a couple other related streams to the business. So the first one is the top right image, the electronic warfare and the signals intelligence business. So we have a second and a $4 million Australian Department of Defense contract right now. So this is applying the artificial intelligence engine for the radio frequency spectrum in other domains outside of drones. So the principle there is most things on the battlefield emit energy. So being able to classify that and understand where it's coming from and what the signal is really important to the Australian Department of Defense. So we've been doing work with them on that front, and we expect to have larger and more comprehensive orders going forward on that as well. And also we do things like what's known as C2 or command and control systems, which currently include our own counter-drone systems and also third-party sensors. And we've been including it with our systems for sale as a bundled product, but starting early next year, following very positive reception of our C2 software, we're spinning it out as a separate subscription product that we will be selling to the customers. And then the bottom right is our artificial intelligence computer vision system of basically being able to use any camera to detect and identify a threat like a drone, like for example what you're seeing in the inset on the bottom right there. So why are we considered to be the best in the world at what we do? DroneShield was the pioneer in the space when we began 6 or 7 years ago, and when that was a fairly unheard of sort of area. Right now it's becoming much more mainstream. So that allowed us time to become essentially really good at what we are. So we can detect and defeat further than anybody else. We have presence in about 120 countries around the world, on the ground offices in UK, US, and Australia. And the US market is probably our single largest driver at the moment. And the brand and the quality of the products and channels to market is probably what sets us apart from everybody else. And a common question we get asked is that, well, what about defense primes? And in short, defense primes are our customers. We already supply to a number of defense primes today, as opposed to them seeking to reinvent the wheel and try to develop something from scratch that evolves really quickly. Now moving to the quarterly update. So compared to the third quarter of last year, we have had about 8 times cash receipts in the quarter that we just closed at 1.7 million. And on top of that, we received 1.1 million in grants, so about 2.8 million total cash receipts for the quarter. If you look at January to September, we're running December year end. We were up about 6 times on the same period last year, so about $10.8 million. We have a strong cash position, so about $12 million as at 30th of September. Very simple balance sheet, no debt, no convertibles, just straight shares. And also over the last several months, we've built a significant amount of inventory, so about $11 million. That is in part, you probably have heard about the disruptions in the high-tech electronics industry, like semiconductors and the like. And also, we often find that a difference between a sale and potentially a sale that's delayed is how quickly you can fulfill. So having that product on hand to meet urgent requirements is important. So we've built that inventory to make sure we deliver quickly. That image on the right you're seeing is work in the US with our partner SAIC that is behind what's known as Medusa program, which is the US Air Force official counter-drone program. So we supply the product called RF1, which is the one to the left, and then there's the radar, which is a third-party product to the right. So the combined system is expected to lead to a major procurement by the US Department of Defense next year. Our outlook is bright. We have approximately $230 million sales pipeline. So we measure that as our total cash receipts that we're tracking between now and December next year. That is unrisked, meaning if something is a lead, it's treated the same way if it's a more advanced deal, but it just gives the sheer breadth of opportunities we have. And this is across about 80, 85 different opportunities. We have experienced a lot of US milestones in the last quarter. So I just mentioned about the integration with the US Air Force, but also critically, we've been selected towards a acquisition program of record that we expect to finalize and enter into in 2022. And for those of you who are less familiar with US defense acquisition programs, so a program of record is effectively the holy grail of the defense procurement in the US, where it begins with a very meaningful order. So it will be a number of millions of dollars value for us, both upfront and also on the subscription basis, as well as the continued funding towards more acquisitions. We already talked about the existing $3.8 million electronic warfare contract that's going really well, and we expect to have follow-on and larger orders in the next several months. The next point is about the macro environment. So in short, this is the best time probably ever in Australian history to be in the defense and security industry, and also in the counter-drone specifically, and the same thing globally. And also in the current environment with COVID, we're finding that defense and government agencies are continuing to spend, and our shipping and manufacturing processes are quite robust. So we have continued to deliver over the last 18 months challenging period. We entered into adjacent markets like training and simulation, which are valuable on their own and also as means of selling our core products. And like I mentioned, we're continuing to build more and more of subscription revenue as part of our overall product suite. I'm mindful of time, so I will largely skip over slide 10, but the main point there is 85 different projects split across different geographies. US, Australia, and the Middle East constitute major opportunities for us, but it's the breadth of different deals which gives us certainty in terms of making sure we have cash receipts which are growing over the next several quarters and beyond. A little bit more to our pipeline. So we have a lot of projects across different stages, and right now it's about 3.5 million in firm purchase orders, mostly US based, that we are delivering, but also we expect even this quarter to convert a number of opportunities which are currently in the final stages into the purchase orders. Slide 12 looks broadly at our increase in cash receipts over the last 5 or so years. What we say here is it's not just about the increase in dollars, but also the kind of audience, the kind of customers, the blue chip customers that we have been securing. So the likes of the US Department of Defense, Australian Department of Defense, UK Special Forces, etc. They're not the kind of customers who will place a $1 million order and be done with it. These are long enduring and growing relationships. Three-part strategy. So we are continuing to grow in the counter-drone sector as the sector itself is growing really quickly. We're going into adjacent capabilities. So we talked about electronic warfare, C2, and the optical detection and tracking. And also over the next several years, we expect more and more of our total revenues to be on the SaaS basis. So fundamentally, as we look at ourselves in say 3 to 5 years from now, we will be a software business focused on government intelligence security markets on top of a hardware platform that's our proprietary platform as well. Electronic warfare. So I think we'll largely cover this, so I'll skip that for the sake of time. And that is over. Thank you. Over to you, Mark.
Thanks, Oleg. I might just kick off the questions. In terms of the cash flow that you got in the first quarter, or indeed over maybe the 9 months to date since your December year end, are you able to break down what cash is coming from hardware sales versus what cash is coming from the software subscription?
As of now, just over 90% is coming from hardware, but as we go, we expect more and more to be software focused, because I guess just mathematically, if you look at it, if every detection product you sell comes with upfront hardware and tail of software, and we're finding customers are continuing to pay their subscription dues over time, we expect for that to become majority over, say, the next 3 years.
And then another question around the hardware. What's the kind of replacement cycle in that hardware? You know, do you need to replace sensors or the deactivation guns on a 3-year cycle, 5-year cycle? Like roughly what would be the hardware replacement cycle?
You can probably think of it the same way as, say, a laptop, meaning after about 3 to 5 years, your computer is still perfectly fine, but chances are you'll want the latest and the shiniest thing, so you'll still be replacing every 3 to 5 years. So I would say that's probably roughly the profile for us as well.
One question here, Oleg. Major competitors, I know you kind of touched on it at the start of your presentation, but maybe just give us a little bit more detail.
We believe we're truly without competitors of class of our own. So if you look at large defense primes, say Lockheed or Thales or Raytheon, so we work with large defense primes as our customers, as they seek us as their supplier of choice for counter-drone systems, rather than trying to reinvent the wheel on their own. Then at the bottom end of the industry, unfortunately, there are a lot of garage sort of businesses with somewhat of prototype products. Unlike, say, 5 years ago, this is not really an industry that can be easily disrupted, because you have a lot of work that we have put in for both the hardware and the software side of things. So hardware is important because it builds our competitive moat. So it's more than just software, which is quite complicated on its own. Within our bracket, there are probably about a dozen different companies that emerged over the last 5 years that play in the counter-drone space. The difference between us and them is they are very individually product focused. So as you would have seen, we have probably about 10 different products across drone detection, drone defeat, portable, vehicle, fixed site, while most of our competitors tend to be single product companies because, well, it's easier, it's cheaper. And also most of our competitors tend to be very regional. So for example, we don't see US players outside of the US, European players outside of Europe, and so on. Why? Again, because it's easier. We take the view that you really want to go for it, and we consider ourselves global leader in the space as the space is increasing. So effectively, more products, being in more places with more relationships, and better products and branding is how we set ourselves apart.
And in terms of exclusive product, especially when you're dealing, I'm thinking on the defense customers now, have you had any pushback on saying, we'd like to use your product, but we don't want this in the hands of XYZ country or one of our, let's say, non-allies?
Completely. What we manufacture are fundamentally export restricted products. So before we ship any of our products, we need the Australian government to be on our side, and that doesn't really stop us in terms of the timing and the process. It's all very streamlined, but in summary, we do not do business with places like China, Russia, Cuba, Venezuela, North Korea, Iran, and so forth. So all of that is pretty streamlined process. When customers, say a European military signs a purchase order with us, they also sign an end user certificate that the products will not be transferred, probably not too different to any other piece of defense electronics. So it's a very tightly controlled process.
Okay, great. And then if we maybe are thinking outside of the defense market, is the market currently just trying to get a handle on, if there's drones in our airspace more, kind of that detection market, or, are you seeing people who, run stadiums, for example, also looking to purchase the response weaponry, if I can call it that, to take down drones? Or are they just trying to get a handle on, are there drones coming into kind of stadium airspace, for example?
There's no simple answer. So most of our customers today are militaries, intelligence services, and also law enforcement. It's becoming more across airports, facility, things like oil and gas facilities, and other, I guess you can call it, non-core government services. Detection is something they can freely buy today, and I mean, assuming they're in the right country, and that gives them awareness of where the drones are, where the pilots are, so they can sense security and apprehend the pilots. In terms of the jammers, there is a lot of legislation around that, which effectively limits it to be a government market. So jamming meaning defeat, as opposed to our detection, which is not as regulated. And what we're often seeing is that for important events at stadiums, you'd have federal law enforcement protecting the event, and that would have more capability to protect the stadium compared to, say, private security would. So in short, yes, stadiums are a market for defeat as well, but it needs to be a particular kind of event, particular profile, and we certainly see that as a very meaningful market, and we are chasing a few active stadium leads around the world, in Europe and UK in particular.
Okay, great. I'm just checking here if we got any further questions from the audience. I'll give it a minute here. It doesn't look like we have any further questions at this time, Oleg. I do know that we have, yes, Maria is standing by. So we might just leave the Q&A there, Oleg. Thank you very much. And your contact details have been up on the that last slide of your presentation. So if anybody does have any further questions or wants to arrange a one-on-one with Oleg, please feel free to reach out to him. I think, Maria, if you want to start sharing your screen, we might kick off a minute or two early.
So perhaps I can kick off. Good morning, and my name is Maria Halasz, and I'm the CEO of Cellmid. Cellmid, as you can see, there is a forward-looking statement, so please read it carefully. Today, I'm going to take you to the 4C we've released on the 22nd of this month. But prior to that, I'm going to introduce you to Cellmid, and also we'll talk about the most significant event operationally this quarter, and that is the acquisition of BLC Cosmetics, effectively doubling our company. So Cellmid is a health and beauty tech business, and we grow shareholder value through distributing proprietary, scientifically validated innovative products. Our products are all in the anti-aging longevity space. Our first range of products is an anti-aging hair product under the brand of Evolis, Jojo, and Maxilis. Where we are is we're addressing a rapidly growing market in functional, high-performing health and wellness products. And as I mentioned, we are really focused on in this longevity, anti-aging space. We have been growing quite strongly in the last few years until we hit COVID. We actually got affected significantly, primarily because our main distribution channels in 2019, prior to COVID, had been bricks and mortar stores, both in Australia and in the US. Obviously, by early 2020, that distribution network got significantly affected, and we still continue to feel the impact of this, although as we've increased our e-commerce capabilities, that is now expected, particularly in this financial year, to really compensate for the sales that we've lost in bricks and mortar stores. In terms of going forward, what we're looking for, certainly we want to integrate our newly acquired company, BLC Cosmetics. The settlement of the acquisition is expected in the next few days, so we're not quite one company yet. We also have distribution opportunities for our products in China and other parts of Asia. Our products are global products in a sense that anti-aging and longevity products are really featuring strongly in people's mind, particularly as post-COVID. People are looking to enhance their lifestyles, and our products are really targeted there. There is a fast-growing middle class in China that is anticipated to hit 500 million people by the end of next year, and that fast-growing middle class is rapidly purchasing particularly goods, both in homegrown, increasingly homegrown, but also imported goods. And one of the biggest areas of growth, certainly for that particular demography, is cosmetics, is where we operate in. In addition to that, as I mentioned, we are growing our e-commerce business. We have launched new digital platforms, both in Australia and in the US most recently. We expect that most of our growth will come from there. Finally, we've got new products that we've developed in the last year. We're just launching the first one, which is a hair loss supplement, and that will be launched both in Australia and the US initially, subsequently in Japan and China. So let me tell you a little bit about the business we're acquiring. And again, we expect to settle by the end of this month. The name of the business is BLC Cosmetics, and it's a leading importer and distributor of international brands of skin and wellness products. The distribution rights are exclusive for most brands for BLC, and they include really large, well-known long brands such as Stelgo, Priori, and cosmeceuticals such as Hydropeptide. The business was established in 1974 and has gone through a number of different stages. Most recently, it's been growing very strongly. There have been some new brands that have been added to the portfolio, which actually resulted in significant revenue increase. The main distribution for BLC is beauty spas, clinics, salons. That includes both in community as well as hotels. BLC is profitable and, as I mentioned, has a track record of revenue growth. They've got about 11 brands at the moment, made about $500,000 last financial year, and distribute to about 900 distribution points in Australia and New Zealand. This acquisition has been highly strategic for Cellmid. We have been looking to grow both organically and also by acquisition. And acquiring BLC actually launches us well and truly into becoming a leading anti-aging health and beauty tech company with multiple brands, not just in hair, but also in skin and body care. We also build services ultimately into this business. Just by acquiring BLC, we will also acquire significant scale, with doubling our revenues from around 7 million in FY 2021 to about 13 on a pro forma basis. The growth that we're looking at is really expected both by putting the two businesses together, but also by jointly exploiting our distribution channels, which are really complementary and quite different. With our increasing e-commerce capabilities, we have an ideal platform for BLC to grow direct-to-consumer revenue, whilst BLC's beauty salon distribution network is absolutely ideal for incorporating Cellmid's original proprietary high-value products. We also have opportunity to make some savings, both around warehousing, logistics, but also in our admin costs. BLC's revenue last financial year, and their financial year ends on the 30th of September, and Cellmid's financial year on the 30th of June, and therefore some of the comparisons I will have to qualify. But they've just closed their financial year, and these the forecast revenue, obviously unaudited, is actually now the actual revenue for them, and it's increased by around 16% this year. Sorry, 20% this year. The growth for BLC is, as I mentioned, is driven by new brands, but also by opening new doors. And that was despite the COVID lockdown. So if you can imagine, the majority of their distribution has traditionally been beauty salons, which particularly in Victoria have been locked down significantly, and for significant periods, and in Sydney to some extent as well. Nevertheless, BLC does have a B2B e-commerce business which continued to generate sales. Earnings, again, around $500,000 profit this year at the EBITDA level. What did we pay for? What are we paying for BLC? Essentially, the deal includes two tranches. The first tranche is $3 million, which is approximately 6 times earnings multiple, and $1 million in cash and $2 million in shares. We've recently had a shareholder meeting, and our shareholders overwhelmingly approved the issuing of the shares to BLC's owners, HGL. HGL is an investment company listed on the ASX as well. We also will potentially pay a second tranche, and that will be on the basis of the increase in EBITDA, and we will be paying a 3 times multiple on the incremental increase on EBITDA. So when you look at other deals in this sector, you can see that the multiples are anywhere between 8 to 20 in this sector. So I'll be very pleased with the multiples that we're paying for BLC, and we think that we're delivering great value to our shareholders. I have mentioned the strategic rationale, but I want to mention just a couple of things about the financial outcomes, and that is on a pro forma basis. If we had BLC in last financial, you would have been at a 13 million revenue instead of the 7 where we ended up ourselves. And we do expect a top line increase in revenues, both organically from both Cellmid's original technologies as well as BLC's, and also on synergistic distribution channel sharing. As I mentioned, the timing of this settlement will be at the end of this month. We expect that by 1st of November it would have settled. But the actual effective date will be 1st of October, which means that we will have 3 full quarters of BLC's revenue in our financials for this FY 2022. We have prepared a pro forma combined financial statement. This is the P&L, and again, we would be looking at, if we were to combine the entity, we would be looking at around 13 million for 21 financial, and an EBITDA of around 1.4 million loss instead of the 2.1 EBITDA loss, which we are reporting currently for Cellmid. In terms of the balance sheet, again, in terms of total current assets, we would be looking at 13 million and total assets of 18 million. This is comprised of 7 million in cash, some receivables over 1 million, and about $4.5 million in inventory between the two companies, which we expect will serve us really well in this financial year. to deliver on the course of objectives of the businesses. In terms of liabilities, we've got about total liabilities combined of about 2.9 million. And our net assets of the combined group is about 15 million. And if you compare that to our current market cap of around 12 million, you can see that the acquisition, once it's settled, is going to add significantly to the current financial position of the company. So what happened in the last quarter financially? We've received around 2.3 million in cash receipts from customers. That was up about 8% from last year, where we received 2.1 million. In terms of our cash burn, was down to $76,000 from 1.45 million for the same period last year. And we have about $6.7 million in the bank. And that is, we expect that to be well enough and sufficient to serve us both in terms of delivering our organic growth objectives, but also to boost the opportunities for the joint business. So what are these growth opportunities going forward? Certainly expansion in China, and I did mention a few words about China, but I can maybe mention a little bit more around this, particularly the prosperous middle class that is rapidly increasing. That middle class is made up to some extent by young Chinese men and women who have been working very hard. They work 6 days a week, 9 hours a day, and as a result, they're increasingly stressed. Combine this fact with having 4 grandparents, as this is a generation that comes from a single parent or a single child policy from China. So these kids not only, and when I say kids, these are 20 to 30-year-olds, not only they are earning very good salaries, but they also have been spoiled by 2 sets of grandparents. This generation has started to lose their hair significantly earlier than the previous generations, where hair loss and anti-aging hair care was considered around their 40s. This generation reports increasingly that in their early 30s, they started to lose their hair and or started to worry about hair loss. So this is a significant opportunity for us. And we signed 2 distribution agreements for 2 of our homegrown brands, one for our Australian Evolis brand and one for a Japanese brand called Joju, to target more towards with their formulation, the Asian hair. So we've signed these agreements in late last year, and already pursuing agreements, we started to sell into the market. Obviously, the biggest sales event, 11/11, is coming up in November. And in fact, it started already. It will be 23 days of sales bonanza in China, which normally represents more than 50% of annual purchases for companies like us. So we're looking at significant opportunities in China from an emerging generation of prosperous young people experiencing age-related concerns much earlier than previous generations. In the US and Australia, we expect that our biggest growth opportunity really will be around our e-commerce platform, and we've been investing significantly, both in terms of growing our teams and also growing our capabilities. When we look at our e-commerce capabilities and we look back 2 years ago before the pandemic, we had 2 people in our e-commerce team. Today we've got 6 and still hiring, plus outsourcing. So we've got a significantly increased capability there. And on that basis, we launched our well-performing Australian e-commerce platform in June this year. And in August, we actually launched our US similar platform. Other opportunities for us are also in Japan, where we have operations and an equal number of staff in our Japanese office. We are building e-commerce capabilities in Japan, but our biggest revenue channel in this country is actually QVC, television shopping, where we have been incredibly successful selling our anti-aging Joju hair care brand. In fact, QVC Japan remains our most significant source of revenue for Cellmid. There's also opportunity for us to grow from the synergies that I've previously mentioned post-merger with BLC. Again, we are focusing on selling Evolis products into BLC's network of beauty salons. We've already launched Evolis into their salons, so that particular activity has started already. And in addition, we are looking at BLC's brands to be made available to our significant e-commerce database. So we are already looking at a revenue increase from these activities. But in addition to that, we see other opportunities, bringing on new brands, for example, for the joint anti-aging longevity platform. And of course, doing partnerships with people. We also have an opportunity to increase our white label product partnerships. Earlier this year, we signed an agreement with Pump Healthcare, and under their brands, they're going to launch a product which we've developed for them and uses our proprietary patented technology, Halasz technology. That first agreement has already been activated, and we actually just shipped the first manufactured products to Pump earlier in the month. We expect that we will be looking at additional opportunities as far as this is concerned. And finally, that big prize for us is we are a science-driven company, and we're building an anti-aging longevity marketplace, which will be very much information advice driven, but we will be incorporating our own brands, in licensed brands, as well as brand partnerships into that marketplace. This is going to be a marketplace opportunity for us that we expect to launch in FY 2023. So we won't be launching it until we fully develop it, and that will be in the first half of FY 2023. Our board is highly experienced, and of course we gain new experience with the BLC management team as well. And in terms of outlook, we do expect that the COVID impact will continue to cover us or follow us in this first half. Certainly in our first quarter, we still had impacted revenues on that, but only slightly, fortunately, as our e-commerce capabilities are increasing and our e-commerce revenue is increasing compared to others. Of course, the BLC acquisition synergies and delivering on those will be a key milestone for the company in this financial year. We will continue to invest in marketing in China. As I mentioned, China is a really big opportunity for us, and we want to continue to focus on our e-commerce capabilities. I also want to draw your attention to the fact that we are a company that focuses on environmental, social, and governance responsibilities. Certainly from an environmental perspective, a company like us that produces a lot of packaging, we're very conscious to use recyclable packaging, which is what we use already, but we want to expand to biodegradable packaging. We also are subscribers and participants in all of the recycling and environmental initiatives in countries where we sell our products. For example, in Germany, we are part of the Grüner Punkt, which is the recycling initiative by the government. So thank you very much for your time, and I'm ready to answer any questions.
Thanks, Maria. I'm going to kick off the questions. Just on the impact of COVID, have you had much in the way of supply chain disruptions in terms of, getting inputs from your various products or getting your in-licensed brands actually into Australia that you can, have stock on hand for when all of these spas and hotels and things start opening up again?
So look, we have been aware from the very beginning of the pandemic that supply chain issues might arise, and we have pre-ordered and continue to pre-order all our products well ahead of time, because clearly, as far as the US is concerned, our supply chain is completely buggered there. It's very difficult to move things around, and we certainly experienced that from a direct-to-consumer shipping perspective, but not from a wholesale perspective. In terms of Australia, China, again, we pre-order all our packaging that comes from China well ahead of time, and we order large quantities. So when you look at our cash flow statement, for example, you can see that there's a significant increase in manufacturing and in inventory funding, and that is directly related to our plan or our activities around, holding a larger stock and inventory on hand, and also holding a lot larger work in progress inventory to ensure that we're not going to suffer from supply chain issues. So far, we only experienced in the US direct-to-consumer shipping times have stretched out significantly. So, but we've also instigated a premium shipping option for our customers. So, if customers ship in the US or purchase something on our website in the US at the moment, we provide them free shipping over a certain amount. However, if they want to opt for a faster delivery, then they can pay for the shipping. So we're trying to manage it with increased inventory, increased work in progress, increased raw materials, and providing options to our customers for shipping.
And just you mentioned Singles Day that's coming up in China next month. In terms of seasonality in the business, maybe on a go-forward basis rather than a historical basis, given how big the acquisition is it kind of going to even out, or should we still think of let's say this last quarter with the run into Christmas in Australia, and then Singles Day being kind of the biggest quarter for the business, and the first half generally being bigger than the second half?
So we will currently our seasonality is very significant, and the first and the third quarters are very slow, and the second and the fourth quarters are significantly up. And when I say significantly, I'm talking about double or more the revenue. So we certainly will continue to experience some of that, but by acquiring BLC, we will even out the revenue across the quarters, because BLC's seasonality is not so pronounced, and also it is a little bit different to ours, because obviously BLC's business is mostly Australia, New Zealand, and the Pacific Islands. So those are the distribution points for their business. And so we believe that that acquisition, and it's a really good point actually that you raised, and certainly we've outlined that in our 4C operations update. It's one of those critical things to even out our revenues, and with the BLC acquisition, there should be a significant effect to that.
And in terms of future acquisitions, is it a case of looking for more brand distribution rights so that you can, you've got a big distribution network, and, the more brands you can kind of push through that, the better? Or would it be more, buying a brand outright and then, plugging that into your distribution network? So
I think both. We would be looking at authentic brands if we bring them on, or from an acquisition perspective, if we want to go there, it has to be an authentic, conviction-driven brand, very similar to our own, which is really driven by a strong story around consumer need. So it has to be a conviction-driven, authentic brand if we were to acquire a brand. It also would have to be have a loyal customer base. So perhaps what we're looking at next is really broadening our e-commerce customer base. And so we would be really interested in looking at those businesses that have that tens of thousands of customers that we can bring on and really share and the products with. So really we're looking at both, bringing in those authentic, conviction-driven brands that will actually add to the credibility to our own existing distribution network and our own customers in terms of the business, but also distribution base. And that is primarily, as we are growing our e-commerce business, as we are building up capabilities in that area, primarily we're really looking at an e-commerce driven acquisition, really.
And I'm guessing, is that then something that would be primarily Australia based, or could it be international? It just, as you say, as long as it kind of fits the e-commerce criteria, does it matter if it's Australia based or international based?
Look, not really. I mean, we've got global products. As far as our own proprietary brands are concerned, those have global potential, and we're only scratching the surface with the growth of those products. Really, our biggest market is Japan and Australia, really. And even in the US, due to the pandemic, we've wound back operations. So our ability to expand there wasn't there in the last couple of years, which we're now closely monitoring and growing. But really where the customer bases won't really matter that much. We've got operations in the US, Australia, and Japan, so we can very quickly, get into a market from either of those operational centers.
Okay, thanks, Maria. I think if we don't have any questions from the audience at this time, I do know our next presenter is waiting in the wings for us. So Maria, thank you very much for your presentation. And as you say, we'll watch out for the finalization of the acquisition in the next week or two, hopefully. I'm sure you'll be glad to get everything signed, sealed and delivered in full. And thank you for joining us this morning on Coffee Microcaps.
Thank you so much, Mark. It's been a pleasure.
So Maria, if you could please stop sharing your screen, and Brendan, if you want to start sharing yours, and if you could just go to slide share presentation. Yep, there we go. Okay, I can see the cover slide of your presentation now, Brendan. Ready to start when you are. And just take yourself off mute,
okay.
Brendan.
Thanks, Mark. Can you hear me okay?
We can hear you now perfectly. Thank you.
Wonderful. All right. Look, thank you, everyone, for joining us today and for welcoming me. Today we will, if I just get used to this, and so normal disclosures apply. And today I'd just like to share with you a little bit about AD1 Holdings, our team, the business model, some of the highlights so far. Certainly share the 4C results, which have just been announced this morning, and of course answer any questions as we go through towards the end. So a little bit about AD1 Holdings. We're an ASX listed technology company, really focused on the SaaS business, and we're a portfolio of 3 businesses, and supported by a shareholder, shareholders, but also a management interests that are strongly aligned. So almost 40% of shares on issue are held by management and board of directors, and we're heavily incentivized to make sure that we grow significantly over the coming years. And we'll get more to that as we go. But the software as a service business is is really, it's changing the way we work. It's going through significant change, particularly as workforces have to automate and become more digital. And clearly we know the pandemic has really sped that process up. But just to show you here, in 2015, the industry was globally valued at about 31 billion. You can see the growth there, but by 2025, expected to be valued at about 436 billion. So it's significant growth and a massive opportunity for SaaS B2B businesses. So we're really excited. We've had some excellent growth in the last 12 months. We have just signed up a great channel partner in the US, so we'll speak a little bit more about that. On the right side of the slide, current market cap is about 21 mil. Share price is sort of fluctuated between, in the last 6 months anyway, from about 3.4 cents up to about 4 cents. Shares on issue 604. We have just done a cap raise, so that's increased by 60 mil. And you can see there that the unlisted options of about 245 mil at an exercise price of 19 cents. So that's what I was referring to before in terms of the board commitment and incentive to really drive this business forward. You can see the substantial shareholders there to the right. And just to introduce the board, this is the board. We have Andrew Henderson on the left, very experienced, over 20 years in the technology industry, very entrepreneurial, founded and sold, and currently MD of Jitterbit Asia Pac. Michael Norster, entrepreneur, also very successful in building technology businesses, and with particular involvement within the utilities industry. Nicholas Smedley, mergers and acquisitions background, and you can see there, chairman of various boards. And Melissa Richardson, who joined the group 12 months ago, actually, is the founder and director of Art of Mentoring. And that's really our flagship product at the moment that's getting a lot of attention and winning great market share. That's me in the middle, 20 odd years experience. Typically I did come out of the staffing business within the technology field, experience in both prof services and recruitment. I've been in the business now for a little over 3 months, so as CEO, and prior to that I was doing some consulting work in. So I mentioned before, we're a portfolio SaaS business. We currently have three divisions, and they do represent a solid mix of industry diversification. They're aligned by technology, which enables us to consolidate a range of business operations, and we benefit from the synergy in some core functions. So if I dig a bit deeper there and we look at the two businesses, both Apply Direct and Art of Mentoring, those businesses belong in the HR technology vertical, and both are about improving employee experience and driving engagement from candidates searching for jobs, applying for jobs, right through to career development. So if I look at Apply Direct, it's effectively a recruitment platform that facilitates direct sourcing through candidate attraction and engagement. We're split into two key areas. One is enterprise, focused on enterprise customers, and the largest customers will have the brand. I work for New South Wales, and if you search a job to work in the government sector in New South Wales, that platform will come up, and you'll be able to search, learn about New South Wales government, what it's like to work there, and then facilitate an application. That is effectively the enterprise solution. It is a opportunity for employers to centralize and aggregate all messaging about their departments, about their organisation, what it's like to work there, and then showcase the different careers and job opportunities that they have. It's a central source of information for candidates to then search and apply for jobs. Now, interestingly, what we've seen in the last couple of years is the importance of career sites and career site technology explode. So candidates are now more informed than ever when searching for jobs. And we all know right now, employers, companies are wanting as many candidates to apply for their jobs as possible. So the studies, there's a range of stats on this, but something like 85% of candidates will go to a career website first before they decide to apply for a job. So if you think about an organisation that's, you know, got a whole lot of priorities, but they do need staff, and more the priority of staffing and recruitment is, you know, on the minds of everybody. It can be quite a fragmented approach to sourcing candidates. So the hiring manager might go out, they may have HR, they may not, depending on the size of the organisation. They may have a talent team, they may not. They may advertise on SEC, they may advertise on Career One, they might do a whole range of sourcing activities. But what tends to happen for the candidate is the candidate has a very messy experience and they need information. So what am I being told? They might be called by recruiters, direct from an organisation, and there's many organisations recruiting. So I wind this up, but effectively this product streamlines the recruitment process for organisations and makes it simpler for candidates. Once a candidate's working in an organisation, we need to keep them. And I don't know if anyone's been reading about the Great Resignation, believe it or not, but, you know, I was speaking with someone well qualified to comment this week, and they said it's absolutely coming here to Australia. It's in the US and it's on its way. One of the most important things we can do to keep candidates in employment, in our employment, within the organisation we want them to be in, is to support their learning, support their development, and build engagement. Art of Mentoring provides, it is a great product, world leading in terms of providing mentoring software and educational services. It provides the platform and is directly correlated to employee performance, productivity, engagement, retention, and overall well-being. So our platform automates mentoring. Lots of organisations, as much as they believe mentoring is valuable, do it on spreadsheets. And this particular platform, through algorithms, matches candidates and then provides the learning and support and the program and the materials and content for to enable great mentoring. Typically, it drives engagement. We know that mentors are 5 times more likely to be promoted than non-mentored peers, and retention rates are 1.5 times greater amongst those that are mentored than those that are not. This product, given where we are in the world, is growing very, very quickly. We've just signed up HR.com in the US. They have 1.9 million members. That is enormous for us to expand and really penetrate and build, you know, out connections with that community. Utility software services, a little bit different to the other two. It's but a SaaS business, and its core focus is the provision of software and services that enable energy providers to manage their customers in a most effective and cost-effective manner. There's 3 core platforms, but you can see they're focused on customer relationship management, billing, and online customer portals. That's a really great business model, and I'll talk to that a little bit more later. And currently, you know, I'm predicting you're reading the slides, so you know, the opportunity to continue to invest in product and make it more user-friendly and easy to implement is a key focus for us. In terms of some of the customers, we really do have a great client list that's continuing to build, particularly around government associations, and we're building more out into the corporate space. We have a very big focus on renewing existing customers. It takes a lot of work to get customers. Typically, we need to keep them. Our retention rate is currently 90% plus, and we continue to grow and sign new customers that are providing scale across the business. So this slide represents some of the investor highlights. As mentioned, we are building a scalable, multi-vertical, high-margin SaaS platform. The benefits that having these SaaS verticals provides is, there's a range, but a similar target in terms of customer base, complementary products that can be integrated, and the ability to deliver sophisticated solutions for enterprise customers. We are continually working with the customers to enhance product, to understand, market in terms of direction, and how then to provide improved support. So we can scale, and clearly channel partners are really important to that. So we know we've got great platforms, and we can implement well and quickly. This is the investment, so the share price history to date. You can see there we've cut it back to July 20. We know that our strategy is working, and in the last couple of years we've doubled revenues, we've grown our customer base, we've integrated 2 new businesses into the Applied AD1 family, and we're continuing to grow revenue year on year. We've just we'll get to the 4C in a minute, but we just had a really great start to the quarter, and we're focused on organic growth. So our platform growth, revenue's up 65% FY21, and the September run rate was up 10% as well. So this is a brief summary of what was released this morning to market from 4C. So you can see, cash receipts on the left from Q1 FY21 are growing well. Customer receipts, 52% increase compared to the previous Q4 FY21, and up 125% compared to the previous quarter, same time last year. We've had some great wins, real testament to the quality of our product, that includes the Australian Department of Defence, through Queensland Department of Cabinet. We are really focused on building out our go-to-market strategy for the US, particularly relevant for Art of Mentoring, which is gaining more and more interest, not just for the platform, but for the training services. So I'm not sure if I mentioned before, but training demand is up from international customers 514% year on year. So continues to grow momentum. So the business model, which we'll get to shortly, for the utility service division, is sort of supported by customer growth. So as our customers grow, so do we, based on the modelling business model. So up 8% on the quarter, and up 60% for the period last year. What I haven't spoken too much about is the Apply Direct, the new product that we're building in pilot. What we've learned is that lots of SME type businesses need support with the candidate attraction piece, and so that they can have consistent brand and message to market. And so we're building, and we've just signed up our first customer actually to provide that seamless branding, customer engagement product. So and that's really to drive scale, and will be an off-the-shelf product, but very complementary to AOM. So getting cross-sell synergies super important in that space. We've just completed a $2 million placement that goes in part to pay for the second tranche and final cash component of the AOM acquisition from last year, and the other will go into product. So Successful expansion has provided a good foundation for growth. Each business is adding strong numbers to its customer base. You can see there's some good numbers and continuing to grow revenue growth. So that's fairly self-explanatory. But our focus is clearly organic growth at the moment, getting the product market fit right, making sure that our products are scalable, and we'll continue to diversify our customer base and be proactive in identifying our complementary solutions into the offering. Three key horizons to date. The integrations are complete. We're really excited about future prospects. I mentioned Art of Mentoring will lead us into the US market. Channel partner agreements that some are in progress and others have been signed. Notably, the largest being HR.com. I didn't actually reference the scale of that opportunity. So our largest membership company that we have signed in Australia, the most aligned to HR.com in terms of service offering, has about 19,000 members, and that channel provides us to about 6 to 10 new customers a year. So 18,000 members, 6 to 10 customers a year. HR.com has 1.9 million members. They will be supporting us. They'll be driving a lot of it themselves out to their marketplace. Whereas here in Australia, we drive our own with the similar channel. So the potential for scale, we're really excited about it. It's early days. That project is currently being implemented, and we should see, really get to test that in terms of the opportunity in the second half of the year. But, expanding footprint internationally, but not forgetting the opportunity here locally. So the opportunity locally is still really enormous, where we haven't really penetrated the market to what we could yet. And, as mentioned earlier, this market is growing very quickly. Our revenue model by vertical is here. You can see top left monthly fees, but each business comes with an implementation fee. That's about having a highly configurable product. So subscription fee, implementation fee, and we charge on monthly. At an enterprise level, for Apply Direct, the typical value of contract is approximately 200,000. The off-the-shelf product will be less than that and more scalable. So, and by less than that, I'm referring to, sub 30K on average. Art of Mentoring, you can see there, similar pricing model, and the costs there. Utility software services is typically a larger implementation, and with higher revenue for contract. So earlier I mentioned the predicted size of the SaaS market. Our addressable market is also in high growth. So you can see there 49 billion, forecast to grow to about 158 million. If we look at the talent traction piece down here with Apply Direct, global market 17.6 US dollars, and the US market 3.1. The Australian market you can see there, and less than 1% penetration. So Art of Mentoring, similar opportunity for scale and growth, and USS, utility software services, also big opportunity in what is a very fast growing, fast changing environment in the in energy. We all know and hearing a lot about it at the moment. So a great space to be involved as well. This is growth initiatives, some of the achievements, lots to look forward to, lots to do. We have a very experienced board who are really supportive and have a desire to execute our strategy of growing and investing in SaaS businesses. We have a dedicated team across the 3 businesses as well, really excited about the growth opportunities. We have a very big focus on putting the customer first moving forward. It can sometimes be too easy to get caught up in product, being a technology business. Well, product's no good without the customer. So we've got a massive focus on understanding customer and delivering to needs. We're really committed to building our channel strategy onshore and off. Really excited about the growth opportunities in the US, which you've probably picked up by now, and we'll continue to, with our M&A strategy to acquire, integrate, leverage the synergies across the companies and grow. I won't go through each one of these, but so far, good growth story, particularly in the last 2 years, where we've doubled revenue and added 2 new businesses. That sort of brings me to the end. Mark, happy to take any questions.
Yeah, I'll maybe kick off, Brendan. In terms of additional verticals moving forward, I mean, is the model for AD1 something similar to, I'm not sure if you're familiar with Tiny Capital and Andrew Wilkinson, a business based in Canada, where they've pick up multiple kind of profitable technology businesses, wherever they can kind of find them. What's the kind of thought on additional verticals? Might be, I don't know, healthcare SaaS, for example.
Yeah, so it all depends. For example, if you look at the HR tech space there, we're at the front end in terms of talent attraction, employer brand. And we've got a lot to do with that product in terms of building out and realizing opportunity. And then we're also in the candidate retention, talent retention, development, and engagement. There's a gap in between that process, and if you look at across the HR space, that there's onboarding, there's a whole range of specialist services, from reference checking services all the way through. So it's an enormous space. So we're have been looking at companies where it can help connect those dots. If there's an organization that sort of fits in with what we're doing, is complementary to our tech stack, is right for growth, where we can create synergies, then we look at it. Over the last few years, we've made some structural changes to support the strategy. So we're centralizing engineering, we're re-engineering processes to ensure a common approach to delivery, and centralized development resource pool. So these are some of the synergies we can get. And the value proposition of centralizing, back of house resources allows us to go to market as separate brands, but have a common approach to product development. So in terms of acquisition, where we can bring in additional portfolio customers that fit in with that model, then we'll look at it. But the next part of that is really about realizing or allowing for logical cross-sell between customers. So, some people are probably thinking, or could be thinking, USS there is very different to HR tech. It is, but it's also a SaaS market that's highly disrupted, and the technologies are very similar to Apply Direct and AOM. So it fits from back of office, but the front of shop is a little bit different. So we're open, I suppose the answer is, but we must have, be able to gain synergies, and certainly back of house complementary services, if that makes sense.
Yeah, and a question from the audience. They want to know why you didn't raise additional capital. The 2 million seems low compared to burn rate, current cash balance, drawn debt funding. Maybe you can give us a bit of an overview of kind of how you landed on that quantum of 2 million.
So we're the answer. So I just want you to know, I'm talking a little bit about past here, and I've been in the business for 3.5 months. So as a business, we've gone to market a few times, and we're really conscious of doing that and not providing the benefit or the expectation that may have been set. So we last year we raised 2.5 million, which helped with the acquisition of Art of Mentoring, and that was oversubscribed, and we didn't take it. And we didn't take it because we didn't want to. Well, we didn't take it because we'd taken enough in the past, and we want to avoid keep going back, and we need to start delivering and executing on what we say we're going to do. So the 2 million is enough for what we need. We'll be looking at other capital arrangements, but we're currently, earlier this year we built out the $2 million facility, but we're really wanting to drive some solid organic growth now, and we feel that we're in a position to be able to do that.
Okay, great. And just a question on USS. Do you think that its platform could be applicable outside of Australia, or
Yes.
is it is? Okay, great.
Yes. 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 We're very focused on here in Australia. We've got some. The USS platform has been very bespoke, and with a bespoke product, typically, highly customized, and it takes a lot of support. Product development will involve modularizing 3 of the specific products that we have, so that we can increase the scale, but also improve the speed of implementations. So that's what we're trying to do. That once we get there, certainly be opportunity to go offshore with that product.
And just a question on investment in product. In terms of R&D, how do you think about that as a cost? Do you say it's, a percentage of revenue of each of the 3 verticals, or is it, more customer led, and it, might be, 10% for one, but it could be 25 for the other? I'm just trying to get a handle on, how you set the R&D budget in terms, because I'm sure every customer wants every bell and whistle. So it's how do you kind of rein that in to be a comfortable number?
It's a really good question, and I think in the past, squeaky wheel has got the dollar. So we're moving toward a more configurable product versus customizable product. So that under a true SaaS model, you work with customers for roadmap and also include innovation. And then the benefit is that all customers, if can toggle on, toggle off in terms of new features, get the benefit of the group versus trying to fund customized changes. So there's quite a bit of investment going into new product development, and that's the Apply Direct off the shelf. There's the AOM enhancement of product, and that is the closest version that we have to off the shelf, and that is moving quickly. So, we've got to continue to be innovative. For example, that space, for those that don't know, Cronus is a large competitor in the US, and they recently raised 78 million, and that's for product development and to invest in sales globally. We also know there's some other businesses over there that have underinvested in product, and they are losing market share significantly. And we believe that our product is now ripe to start taking that market share over the next few years in the US. The investment decision is driven partly by customer need and demand, but also about future technologies that better automate process. So, are we putting a percentage across each business? Not at this stage. Not at this stage.
Okay, great. Brendan, that nicely brings us up on time. Thank you very much for joining us this morning and giving us a great overview of AD1. And we'll certainly be keeping an eye out as we move through the next 6 to 9 months. Definitely sounds like there's a lot happening under the hood.
Yeah, look, we're really excited, Mark, and thanks for the opportunity. And yeah, look forward to speaking again at some point.
And Brendan's details have been up there, so please feel free to reach out to him if you've got any further questions. Brenda, if you could stop sharing your screen, thank you. And Simba, if you want to start sharing yours. Yeah, I can see the cover slide of your presentation now, Simba, so ready to start when you are.
Thank you, Mark. And thanks to everyone who has joined us for your interest in Angel Seafood. I'm going to be talking about the quarterly that we released yesterday. So this presentation is available on the ASX and on our website as well. I've only added a couple of slides just for the benefit of people who might be hearing this story for the first time. So who is Angel? We are today Australia's largest producer of Pacific oysters, and we're the first pure play oyster company that listed on the ASX. We are a company that has grown from a small family owned and operated business on the Eyre Peninsula to being the largest now in the Southern Hemisphere that produces Pacific oysters that are both organic and sustainable. And our growth has been brought about by coming into an industry that was a cottage industry where there were lots of small scale farmers, mums and dads who were producing oysters on small oyster farms in South Australia. The small oyster farms were received from a public call that was done in the early to mid 80s. So it's an industry that is about 35 years on average. So a pretty young industry compared to some of the well-known oyster provinces like, France, and when you're looking at even the Irish oysters, which have been there for 2 or 3 centuries. So pretty young industry in Australia, but doing really well. So today we have, being young and new in this industry, we have implemented world-leading farming practices, which have actually seen us getting much better productivity levels and also producing a premium product that is well demanded. We are benefiting from the economies of scale. So compared to what the industry has been, we are essentially a consolidation play. We've been buying up small farmers and corporatizing the industry. And we're getting to the point where we're really seeing those economies of scale coming through the numbers that we are reporting. We sell our oysters here in Australia, but we've also been exporting, particularly before the pandemic, and we see the export opportunity as a big opportunity for Angel going forward, because the oysters that we produce being organic and also sustainable, there's a strong demand, particularly in Asia, where people really love their oysters and seafood in general. And Australia is seen as a very clean source for food. So that provenance of Coffin Bay really is something that makes our product highly desirable by consumers. We are currently executing our 3-pillar growth strategy, which when we announced it, we're doing 10 million oysters a year. When the company listed in 2018, we were doing about 2 million oysters a year. So we've grown to 10 million and we have announced our desire to grow from 10 million to 20 million, because we see that further growth is the demand is there for the product, and that further growth will only make our numbers much better. and improve profitability significantly. We are profitable, and we generated positive cash flow in prior years. This year, we have set ourselves on a path to grow, and part of that means we're investing in our biomass. So that will come in the numbers that I will discuss shortly. But that is a bit of background about Angel. I think I talked about Coffin Bay, something that people who might not know how the oyster industry operates. The water that we actually farm oysters out at sea in bays, and we own the lease, and the leases are given by the government, and they are long, they are yours for life, forever. So you just follow an administrative process to renew those leases. We own about just shy of 100 hectares, and what we have developed is about half of that. So we still have some more water that we could develop to continue on the growth path. The water is quoted, so there's no new water being made available. So all the water that we now own, we have had to buy off other farmers that are coming out of the industry. So that actually creates a bit of a barrier to entry. So the more water that you have, the more value you can generate, and there won't be new players coming in. So a lot of our production, whilst we have increased production through productivity, most of it has been replacing some production that was already there, but doing it in a way that actually reduces costs and increases profitability as a corporate. Now I'll get into the results, I suppose, for this last quarter. And I think I just want to start by saying everyone, I'm sure no one needs reminding, but the restaurants haven't been open. That was in Sydney and in Melbourne, which are the major markets. So compared to last year, this was a challenging environment. We also had less of the government stimulus spending that was there last year. So JobKeeper wasn't there, JobSeeker wasn't there, which is something that you would think is going to dampen the demand for a luxurious product such as an oyster that people tend to consume in restaurants. In addition to that, whilst Queensland and South Australia and the other smaller states were open, those states tend to really rely on when it comes to restaurant patronage, they rely on tourism, and the borders were closed again. So this was a very difficult quarter. But despite all these challenges, we are pretty pleased that we managed to grow our revenue 5% compared to last year to be 2.1 million. So we sold 2.7 million oysters, which was equal to the previous record that was set last year. So we're pretty happy with that achievement. And what that shows is that the demand for oysters is growing, the underlying demand is growing, and we've got a product that people are willing to consume even through difficult times. So we are very happy with that. Another key highlight was that we managed to grow our biomass by 94%. So the biomass is the stock that we're holding, and we look at biomass as the lead indicator for what cells we're going to have in the future. So the fact that we are 94% better as of 30 September compared to that time last year shows that for us, we are very optimistic about getting into Q4. And I'll talk about the future shortly as well. This slide just shows, again, what I've just been talking about, the growth that we've experienced. On a year-to-date basis, we have grown 17%. So that is pretty impressive, given we're still going through a pandemic and there are lots of restrictions that would be a handbrake to our growth, but we're still managing to grow. Our biomass, September 2020 was 256. we ended up selling about another 3 million oysters in Q4 last year. So we are very optimistic about Q4 when we are sitting on biomass of 496 tons. So that biomass is the combined weight of all the oysters we have in the water, which is about 30 million oysters. So whilst the quarter was a bit hard, I think we were very pleased that towards the end of the quarter, we started seeing with the warmer weather coming, and also New South Wales and Victoria starting to come out of lockdowns. We saw sales in September increasing 66% on August. So that is a very good. That was a very good number to exit Q3 with, and some of those receipts will flow into Q4 as well. We are very optimistic that the borders reopening and people, so both domestic and international borders, and people starting to travel again is going to be something that drives demand for oysters. And we're getting into a festive season as well, so that people tend to consume a lot of our product around that time. We're also very encouraged by the recent supermarket data that has shown that the consumption of oysters in the oysters that are being purchased through the retail chain increased 83% last year. It's something for anyone who's been following our story. Our pivot to retail was one of the reasons why we managed to survive the pandemic, if I can put it that way, where restaurants, where we had normally sold about 90% of our product through the food service. So food services, restaurants, and different functions. But we quickly pivoted, and last year we ended up selling 90% of our product through retail and 10% through food service. So as the largest producer now, we are really well positioned to be able to dominate this growing market of people who are buying oysters in the supermarkets to consume at home. When you look at the price of an oyster in a restaurant, you're paying about $6 to $7 each. And I think younger families, whilst they enjoy oysters, people are becoming more and more confident about buying them through retail and enjoying that food at home where you can get it for cheaper. Both channels will still give us the same amount of money. So we are pretty pleased by that aggregate growth in demand. So yeah, we are very happy as we are getting to Q4 that, you know, the strong position that we have. The other key thing that we are pretty pleased with as we are exiting Q3 is that we've recommenced exports into Asia. Still very low quantities, limited by the availability of freight, but we are very happy that the demand is there and our customers are continuing to buy from us, even though there are challenges as far as freight costs are concerned. So I talked about the 3-pillar growth strategy that we're executing. So this was to get us from 10 million to 20 million oysters. The reason why the 20 million has a much bigger dot is that represents the profitability that we're expecting. But the 3 pillars that will get us there is increasing scale, because we know based on the work that we've been doing that the economies of scale are proven, they're definite. So we're going to continue to pursue that within the Eyre Peninsula where we operate. The second pillar is increasing productivity. Since this company listed, we are now able to produce 47% more on a hectare that we have developed compared to when we started. And that has been achieved through bringing in a team, people that are actually experienced, and funding research and development, which normal farmers in our industry couldn't do before. But we're able to do that because we've got the resources. Data analytics has been part of one of the things that we've been doing as well. So a lot of innovation has seen us increasing our productivity. And then the third pillar is to improve the average price that oyster through premium branding and marketing activities in general. We look at the price of, we get about 80 cents an oyster, but we know half the oysters that people eat are sold at $5 and above. So we always look at that difference between what we get as farmers and what people, the final consumer is paying. And we are looking at strategies of competing for that gap. To increase what we're getting and bring ourselves closer to the final consumer. So I'll talk about that a little as well. So in terms of the key initiatives that we have underway, as I said, we've got the water to increase the scale, so I won't talk about that in too much detail. But we have flip farm, we have started implementing our flip farms. A flip farm is has slightly different infrastructure to the farms that we've been using, which are called intertidal farms. I will be happy to go into more detail if anyone wants to know a little bit about this. I know we're limited for time, but the flip farms, what they do is they will reduce our labor costs. So instead of having people jumping into the water and getting all the baskets out of the water. So there's this picture here of people standing in the water. You can see they'll get the baskets and put them onto a boat and then take the baskets onto a land facility for grading and sales. What flip farms do is the baskets are already fixed on the infrastructure. And what we have is we've got a boat that has got a mechanism that can get the stock out of the basket or even put stock into the baskets without having to get the full basket off. So I know it might be very brief for anyone who is seeing this as a new concept, but what it does is reduces our labor cost by about 50% and also brings into play, we're able to develop water that was too deep for us to develop. So these guys are standing on the water. This might be low tide. So the farms are on very shallow water out at sea on the bays, but there is also very good water that has been too deep to be worked. And the flip farms will bring that water into play for us. And that we also, the work that we've done to date shows that the flip farms also increase the quality of the product that we're producing. So a much cleaner product comes out of it. The next key initiative is what we call summer oysters. We have been able to sell our oysters for 10 months of the year, and the oysters are out of season in January and February due to the temperature of the water, which influences the reproductive cycle for the oysters, and then their condition, once they go through that reproductive cycle, we call it spawning, they are not really in a condition where you can sell them. But our summer oysters are a different type of oyster. So it's almost like a grape without seeds and a grape with seeds, where the normal oyster is the grape with seeds and the summer oyster is a grape with no seeds. The advantage is they don't go out of season. So we've got some stock that we've been trialing. It's the first time it's being done at this scale that we're doing. That is why it is a trial. Otherwise, the product itself is well known. It tastes like a normal oyster. And the end customer won't even know that is different. So we are very excited about having those, and they're now at the size where they're market ready, and we'll be putting them out for sale in January, Feb. So what this means is we'll be extending our sales season from 10 months to 12 months, and that increases our revenue with no further investment in infrastructure or anything, because we're just using the assets that would have been underutilized around that time. Our key initiative as well for Pillar 3, which is going to market, is we have set up the Halo Club. So our Halo Club is a subscription-based, what do I call it? Sorry, just having a bit of a brain freeze here. Subscription-based model, where instead of going through the route of online sales, we have customers who actually subscribe. So you subscribe and you pay a certain fee on a monthly basis, and we deliver 3 dozens of oysters to your doorstep. And you don't get only oysters, you get oysters with some condiments that are curated by a chef that we work with. So it's really giving you that restaurant experience that you can enjoy at home. We've been doing this for now 4 months, and we've been getting very good feedback, particularly our customers that are in Victoria and New South Wales, where people have been in lockdowns. We know that the Halo Club the box has been something that people are actually looking forward to receiving and bringing smiles to the family during those difficult times. So it's something that we are going to continue trialing. The challenges so far have been working through the freight. I'm sure most people will recognize that freight has been seeing a lot of challenges with the increase in online sales and everything during the pandemic. Freight has been a bit challenging to work through, but despite that, I think we have had a very good 4 months, and the interest keeps growing each time we talk to people about it. The key thing about the Halo Club for us is it's going to increase the average price that we're getting per oyster. So at the moment, we're able to attract about between 20 to 40% premium on the price, and we know that once we optimize our freight, where we incur a lot of the costs, that overall margin will increase from this product. So I suppose in summary, just to finish this before I go to Q&A, we are a company that has grown significantly, and we've got the track record for growth. And we're generating strong financial results despite the challenges. We have a strong stock position, so we have already invested in next year's growth, and that is sitting in our stock at this moment. So we're pretty optimistic about the future. And yeah, the growth initiatives are showing very good results, and we are very excited about the future. I will stop here for questions, Mark.
Thanks, Simba. Just a quick question from the audience. Have you got a timeline on how long it's going to take to get from 10 to 20 million in that 3-pillar strategy?
Yeah, thank you. Look, we haven't set ourselves a solid timeline, but it's something that when we started, we said it was going to be a 3 to 4 year journey. We have already increased our production capacity to 12 million. And once the flip farms are fully commissioned, we are very likely to increase to 15 million, because when we say 12 million, we don't count the flip farms yet because they're still a trial. So I think we've got a clear pathway to get to where we want to get to in the sort of next 2 to 3 years.
Okay, great. And in terms of, I guess, how you're thinking of revenue splits post-COVID, as you say, you flipped from 90% restaurant to 90% retail. Are you targeting a kind of a better balanced mix going forward? I don't know if it can just easily be 50-50, but is that something so you're not completely reliant on one or the other markets going forward?
Yeah, no, that's an excellent question. So I think going forward, we will be looking at a split that is, our desire is 50% retail, 30% food service, and 20% export. I think retail is a growing segment, and the good thing about retail is retail is not, sounds like retail is less profitable. When I know that the discussions I have with many people, they ask me why we would want to sell through retail. We get in terms of parity, the retail and food service, we get the same amount of money, same profitability. We sell a bigger product to food service, but it takes longer to grow that bigger product. retail takes a smaller product. They pay a little bit less for that smaller product, but it's also quicker to produce it. So when you take that into account, your costs and just that turnover, we make the same amount. The profitability is not different. So we actually like to have the balance of retail and food service, and then export as well. Retail is a market that we can completely dominate because we have the scale to be making significant inroads in that sector or in that new market, whilst the other smaller farmers, they struggle to provide retail because they cannot guarantee the continuous supply that some of the retail chains demand.
We get two questions from the audience on Halo Club. E33 basically saying it's 221 per oyster versus Halo Club, which is 278 per oyster. Are you? I think you did say you're happy with the take up. Maybe just explain: is the pricing competitive, or are they using a different variety of oysters? Maybe just comment on the kind of price differential between the two.
Yeah, so look, E33 is, we are very different. So they have an online sale, an online shop where people can just buy oysters in, spot sales pretty much. We have adopted a club because we could see our handicap. We are in Coffin Bay, which is a very remote area. So that's got its advantages. Being remote, we've got advantages of, the environment is pristine, but when it comes to proximity to the market, that was a handicap that E33 doesn't have to deal with. They're based in Sydney. So their delivery costs to the end customer will be very cheap compared to us, which is why we don't offer and we don't offer online sales, but it's a club for the reason that the value to the customer comes from the add-ons that we add and taking our customers on a journey, and just having that guaranteed. So if you're going to set up the infrastructure, you actually want to have the guaranteed revenue stream, and that's what we are doing, and that's why it had to be Halo Club. Sydney rock oysters and Pacific oysters are slightly different species. Obviously, the Pacific oysters are generally bigger. Sydney rock oysters tend to be smaller. Sydney rock oysters take 4 years to grow. Pacific oysters take 2 years to grow. So our models are slightly different in that regard. I think we have cheaper costs when it comes to production compared to Sydney rocks. But when it comes to delivery, when you're targeting a market in Melbourne or Sydney, it's easier for E33 compared to for us through the Halo Club. But our customers have been pretty happy with the deliveries and everything that we package together as part of Halo.
Just another question. Cash is down to 1.5 million. Is that due to just getting prepped in terms of, the big summer season coming up and the reopenings? Is it more just a working capital timing issue?
Yeah, look, I think we talked about our desire to grow. So we have 1.5 million and another 1.5 that is undrawn on our working capital facilities. We've got a huge stock position, which we expect part of that, a lot of that will become converted to cash over the next quarter with demand coming back. So yes, it is a timing thing and we are growing. So we'll continue to invest in our biomass. But any investment in biomass will be converted back into cash within a 12-month cycle.
Yes, final question again on the Halo Club. Is there plans to adjust the quantity from rather than 36 to 24 to kind of give people options whether they want more or less, to try and hit people who might have smaller families or indeed might be looking for something bigger on a more regular basis?
Yes, look, we are looking at the reason why it's a trial is we've been getting a lot of feedback from our loyal customers, and for the first time we have offered what we call there's a lighter version that we have offered for the first time. The unfortunate thing is the unit cost per oyster becomes very expensive as well. So 3 dozen seems to be the sweet spot for a lot of people who really love their oysters. And 3 dozen is not a lot. When you get them on Thursday, you do a dozen on Thursday, a dozen on Saturday, a dozen on Sunday, or if you have friends coming over, 3 dozen might sound like a lot, but you can eat them very quickly. So, but yeah, we are looking at options. By the time we say we are coming out of this trial, I'm sure we will have the offer will be adjusted in different ways to try and suit different interests. But yeah, this club, like we said, is not an online sale. So we also know that it's not going to, the value proposition might not be for everyone. We are targeting the affluent person who really loves oysters. And we know we're not in a place to compete with people going to buy oysters at the supermarket. But we are really taking on the restaurants with this offer.
Okay, great, Simba. We're just after running slightly over time, so I think we'll leave it there. Thank you so much for joining us this morning, and we'll definitely be keeping an eye on everything AS1 related over the next couple of months, and best of luck with the reopening of your 2 major markets.
Thank you very much, Mark.
And with that, I'll end this morning's session. We have another 4 Appendix 4C companies reporting tomorrow morning. So please join us for that event. And I'll speak to everyone then and wish everybody a good rest of their Wednesday.